This single candle has generated over $20,000 in the last 15 months. Does that sound crazy? Let's take a look at it together. The strategy I'm going to thoroughly explain and demonstrate to you today is based on detailed calculations made at the order flow level to accurately identify and pinpoint a specific type of market condition. This particular type of market condition frequently and consistently occurs in the futures markets, but we'll get to those details in just a moment. The main problem within the broad world of retail trading is that it's shown online on YouTube and in all the various places where you can find information. In these places, trading is often made to seem unnecessarily and extremely complicated for the average person. So we're presented with an extraordinarily diverse and incredible series of indicators that are stacked on top of each other to build highly effective and amazing trading strategies. The fundamental difference with a single candle strategy is that all these tools, when taken individually, don't actually have a statistical edge. They're simply basic indicators or oscillators. They don't really have any solid foundation behind them, nor are they part of strategies that are rigorously tested and extensively back-tested over long periods. Ultimately, simplicity in trading consistently triumphs over unnecessary overcomplication. Trading should be straightforward, but it is certainly not easy. And what I'm going to show you today is my personal strategy. By analyzing just a single candle through the lens of order flow, we can execute what is, of course, a high-speed scalping strategy. This approach is fundamentally based on the specific principle of a stop cascade. A stop cascade is a fascinating phenomenon that occurs very frequently, especially within the highly liquid ES market, which refers to the S&P 500 futures, and in professional trading circles it is commonly referred to as a stop run. So you've undoubtedly heard many people talk about stop runs. Stop runs are specific market movements that go after what is commonly called resting liquidity. Essentially, they target all the resting stop orders sitting just above or below certain key price levels. You must be very careful because you might frequently hear online that the stop run, especially for those of you who trade using smart money concepts, is a deliberate manipulation, is essentially a strategic manipulation move often used by large institutional players to hunt for and trigger the stops of retail traders. This is simply not true. Guys, this is quite simply because institutional players do not care in the slightest about the traditional stop loss of a retail trader. Did you know that most of the orders you execute with prop firms aren't even orders placed on the market? Because the prop firms, during all the evaluation and funded account phases before going live, you aren't actually placing any real orders on the market because you're trading on simulated trading accounts. So this specific phenomenon essentially functions as a mechanism to capture liquidity. And the subsequent reversal after this phenomenon, which occurs under certain specific conditions defined as a market environment with very low liquidity, finds a highly effective and very interesting statistical edge. Consequently, this approach represents a sophisticated reversal strategy for traders to consider. The price reaches and triggers all the resting orders, and from there a chain reaction is set into motion. Obviously, due to the fundamental principles of an efficient market, the market will always tend to seek to rebalance and correct the significant imbalance it has created. How can a single candle have so many different colors? Such a strong statistical advantage? Now, this is a fascinating and complex phenomenon that is often underestimated, namely statistical validation. But we'll talk about this in much greater detail very shortly. I want to show you exactly how a stop cascade actually functions. Within the order book, there are various limit orders, which in our example are these specific buy and sell orders displayed here, red in red, located over on the left-hand side. Now, these limit orders here are passive liquidity. Looking just above this specific level, there are several orders. Buy stops. Could they potentially also be stop losses? The answer is absolutely yes, but these are not stop losses that are triggered to manipulate the market. Within the markets, in the financial markets, there are specific rules that allow orders to be executed efficiently. Exactly. Consider the very famous matching principle, that is, aggressive liquidity must always match with passive liquidity. This is the fundamental phenomenon through which the necessary counterparty in the market is created. So, an aggressive buyer must take liquidity from a passive seller. In this specific case, it will happen on the ASK side of the book, where all the passive sellers place their limit orders. There are levels that they can be uncovered in terms of liquidity, which essentially means that we have to imagine in our example that there are no available orders. Obviously, in a liquid market like the S&P, this is very difficult to encounter. Or even on the Nasdaq, but again, this is just an educational example. Now let us try to imagine for a moment that within this specific market situation, there is a massive cluster of zero orders at all of these different price price levels. When the price eventually triggers a stop cascade, what exactly is going to happen next? The aggressive buyers steadily push the market upward, and they ask to pay higher prices because there are highly favorable and optimistic market conditions. As a direct and immediate consequence of this, these incoming buy orders will be matched with the existing sell orders currently available within the order book. I will try to keep this explanation as simple as possible because it's an extremely complex topic, and it's not the goal of this video to make it any more complicated than necessary. So what exactly happens in this scenario? When the price pushes upward, all the other orders that were about to be triggered, precisely because they were orders, buy stop orders, since there is no liquidity to match at these levels, will end up matching directly at the very next level of available liquidity. This is a very impulsive price movement. However, we have to imagine that the main aggression happened right around this level and this final aggressive selling toward the end of the candle. So the next candle will be a very expansive one, which will make a substantial upward movement just like this. The strategy specifically involves waiting for a retracement of this candle. So after this candle closes, you enter the trade. It is a strategy that has a very, very interesting statistical edge over the long term. How do you identify a candle like this? These specific candles are identified through a sophisticated mathematical formula that I have personally developed and refined over years of practice based on my own unique trading approach. Quite clearly, this intricate calculation would simply not be possible without the development of a specialized proprietary indicator. Within the chart, this indicator highlights this candle in yellow for me. Here I have prepared an example of a real market situation from a few days ago directly on my order flow platform. As you can clearly see right here on the chart, there are yellow candles that serve as a direct representation of this stop cascade. In this case, if the candle happens to be a sell signal, I will go ahead and execute a buy order, and with a fixed risk reward ratio of 1:1, right? If the candle is a buy, like in this case I sell, and in this case another buy candle, I go ahead and sell again. So here is a perfect example where on the 1 minute time frame, within just a few short minutes, we actually had this specific condition occur 3 separate times. So the specially designed proprietary indicator takes the exact calculation I have fed into it and makes this candle light up bright yellow. This is a pure scalping strategy that works exclusively and very effectively on a single individual candle. Now let's move on to validation. Once you have identified a clear advantage like this in the market, it is not sufficient to just have the impression that it might work. There are specific parameters, even at the professional institutional level, that are used to validate and confirm the strategy. There are the more well-known ones, such as the profit factor, which is the ratio of gross profit versus gross loss. Then we have the win rate, the success percentage, expectancy, which is the average profit per trade, and the drawdown. Then there are more advanced simulations, like the Sharpe ratio or the Sortino ratio, to carefully calculate the return against the risk taken, and other key evaluation parameters. All of these specific trading parameters must be thoroughly evaluated through a comprehensive process of automatic backtesting, and therefore specifically through the advanced order flow platform that I use for my daily analysis. Mine is ATAS. There is an automatic execution of this model, since I was also able to create an automation for this candle. So it's not just for manual trading, but it can be completely automated. The process of backtesting is not simply done by drawing. When you are looking at the chart in scroll back mode, backtesting is not done manually because it frequently suffers from the significant problem of overfitting. This problem of overfitting is also present in automatic backtesting, but nevertheless, backtesting must be done automatically to ensure consistency. Can order flow really be automated? This is actually the most frequently asked question that I receive from traders all the time. Well, thanks to the sophisticated platforms we have available now, plus the incredible help of modern AI and advanced artificial intelligence models, and specifically thanks to these order flow platforms and artificial intelligence, today even a standard retail home trader can successfully use a professional validation method that I'm going to show you very shortly. Order flow data is now fully accessible even to those who are just starting out, at much lower costs compared to the past. All of this data is entered into the platform to generate a detailed trade log, which is the most critical part of the process. And thanks to the power of AI, it is now possible to make even more advanced evaluations and backtesting compared to ever before. Once this entire process has been successfully completed, the edge is fully validated, concrete, and ready to be usable. In this video today, I want to show you a comprehensive validation methodology that can be used especially for a single candle strategy like this specific one. This is a custom dashboard I built using advanced artificial intelligence technology, where I have uploaded the complete log of all the trades I've executed. These were generated automatically directly on my order flow trading platform through this exact strategy. So here you have all of the specific dates and times. As you can see, there are an extensive number of individual trades to review. We start from February 1st, 2025, with stop loss and take profit. In short, all the trades with the exact execution price and an initial equity of $100,000. So here are all the trades made. Once we have all the logs of our trades, we can go ahead and create a comprehensive visual dashboard exactly like this one. And here's where things get interesting. How can I refine and optimize my trading edge much more quickly? Because to do this work here, without the help of artificial intelligence, we would need to constantly redo and re-examine our backtesting over and over again. This happens countless times, and be very careful because no one else will ever tell you this. Online, go and modify the indicator's code. In short, do a lot of complicated things. Instead, right here, simply by feeding our trades to the AI, we can train our AI model to build a dynamic strategy. So here I can choose several key parameters. I can set the monthly loss cap, the maximum number of contracts per trade, the starting capital, add slippage costs, and fetch the data. As we can see in this case, if I set a monthly loss cap of $8,000 and a maximum number of contracts, this strategy achieves a performance of about 16% per year. However, if I also take into account the additional slippage costs and commissions, which are also calculated automatically, it actually becomes a negative value overall. So here I can experiment and interact with the model, which means that by carefully fine-tuning these specific parameters, I can achieve much better results without having to redo the backtesting. For example, if I don't take slippage into account, the most optimal and ideal formula for this strategy would be a maximum of 7 contracts and a maximum monthly stop loss of $1,500. As you can see, we have an increase of nearly double. This strategy manages to perform at 37.63% with an annualized rate of 26%. $37,600. Not bad for a single candle strategy, and the win rate has risen to 55%. Then here is the statistical sample with all the trades. So there are 468 trades executed solely and exclusively with this single candle strategy. The drawdown returns to 3.79, so all very interesting data. The maximum risk per trade is set at $1,000, so the win rate comes out to 54.91% with a risk-reward ratio of 1:1. As I was mentioning earlier, here it also provides us with a full monthly recap, showing us all the specific parameters of our trades executed during the months. So it's truly a very powerful tool if used with leverage. If I take into account slippage and naturally occurring commissions, the final result begins to plummet quite significantly. Look, this is something that nobody shows you. It's incredibly simple and easy to make a strategy look good without taking into account the real-world market conditions. Here in this parameter between slippage and commissions, I also set some conditions. It is slightly more penalizing in terms of market conditions to effectively put my strategy under some stress. So if I apply this specific formula, that is 1,500 monthly cap and 7 contracts. By adding slippage and real costs, the strategy completely falls apart and fails to perform. But I can see that if I significantly lower the overall expenses associated with the contracts, we eventually begin to see a final outcome that is much closer to reality, achieving a solid 55.43% win rate and maintaining a real profit factor of 1.25. This strategy generated a total profit of over $23,000 in a period of just over 1 year. So this clearly shows us the incredible and transformative potential of combining detailed order flow data with this advanced platform that provides us with essential real-time information alongside our very own specialized and unique proprietary indicator. And we utilize an advanced artificial intelligence that, if properly trained, provides us with the ability to build a comprehensive operational dashboard using our actual trading data, where it clearly demonstrates to us both the underwater curve of the drawdown, the worst months, and exactly where the $1,500 cap stopped the loss. This obviously contributed to the significant increase in profits in just a few short months, as we can see here. The overall trading profits are distributed over a smaller number of months throughout the year, but they are much larger than the loss, which of course was set with a strict limit of exactly $1,500. If you want to trade professionally, you must learn to develop your own sophisticated automated software tools to accurately estimate your statistical edge. If you really want to excel and grow in this sector, you must leave behind all the false promises, all the lack of professionalism, and all the inventions that have been holding you back. This has been pushed onto people over all these years. Make sure to subscribe to this channel because I will provide you with all the detailed information you need to finally break out of this frustrating cycle of unprofitability and start working the exact same way that major institutions and professional traders do. See you in the next video.